Welcome back. Earlier today, the Commerce Department revised the GDP gross domestic product up to 5.2% from the prior estimate of 4.9. What we're going to see in just a moment is that this number, in conjunction with some recent Fed speakers, has moved the futures market. We're looking at a Fed cut possibly sooner than expected. In part, and this is reported by Reuters, the upward revision to growth last quarter reflected upgrades to business investment and government spending. Residential investment also was revised higher. Uh, but the big revision, again, is business investment, government spending. Here's the third quarter GDP, the preliminary. We know there's three components: so the preliminary, the revision, and the final. Now, the preliminary was at a 4.9% rate following prior quarters of 2.1, 2.2. So the initial estimate was quite good, 4.9. Well, today, 4.9 was revised up to 5.2, even better than expected. In fact, this is the best number we've seen since October of 21. Now, we know GDP is broken down to several different segments. The headline number, 5.2%, that's in blue. PCE, personal consumption expenditure, the measure of inflation, 6.5%. Business investment is up 10.5. Government expenditures up 27.3, a huge number. Net exports, unfortunately, down around 11.6%. Now, take a look at the green histogram bars. That's government expenditure. That is the highest high we've seen going back over 2 years, going back further than July of 2021. A lot of government expenditures. Now, the reason why we break these numbers down is that maybe we look at our own investment stock portfolios and try to, ascertain if our investments are in line with the growth in the economy. We think about government expenditures, maybe defense companies. That's an obvious direction to think. Also, business investment, the yellow histogram bar, that is the highest high also we've seen going back to October of 21. Unfortunately, net exports are a little bit lower than the prior quarter, and that's kind of a negative. Business investment is broken down to two segments: fixed investment, which includes equipment, software, and manufacturing equipment. Then there's a change in private inventory. That's replenishing inventories based on consumer demand. We talk about the inventory numbers a lot here as well. Well, this is what business investment looks like, up 10% following the prior quarter of 5%. In fact, this is the best number since October of 21. We take a look at government spending, including state and local government expenditures, up 27%, better than the best number we've seen in over 2 years. Government expenditures we see overlaid with the S&P 500. Typically, when we see government expenditures rise, well, there's not necessarily a strong correlation. In fact, prior studies of ours have shown that there is a least correlation between government expenditures and the S&P 500. Of course, government expenditures do affect defense companies and other companies that receive large contracts. So just be aware of that within our own, stock investments. Net exports, we talk about the exports that add to GDP and then the imports that subtract from GDP. So the more that we're selling overseas, the better it is for our GDP. Well, we see here net exports down 12%. That's not good. It's worse than the prior negative 9%. This is actually one of the worst numbers we've seen lately. Although it's not a huge decline, certainly not down to 43% level of July of last year, but certainly we're not going in the right direction. Personal consumption expenditure, it's broken down into durable goods. Those are products meant to last more than 5 years, like cars, appliances, furniture. Non-durable goods, short-term items, clothing, food, fuel, and then, of course, services like banking, healthcare, and education. This is really what represents the U.S. consumer, I would say, to the best degree, up 6.5%, although we can see over the long term, there's a long trend to the downside. It's not an awful number, but we'd like to see this break this trend. The consumer is fighting back, but despite high interest rates, we're not able to make tremendous progress moving forward. So, what we can ascertain from this is that personal consumption expenditure, it's okay. The business investment and government spending, especially, has improved. The overall number is up 5.2 versus the initial estimate of 4.9. What does that mean for the overall economy, though? And what does that mean for the Federal Reserve and their future interest rate decisions? Well, the futures market has been listening. The chances the Federal Reserve will not raise rates and keep them unchanged at the current 525 to 550 level, this is for the next meeting, is 97.1%. It stayed really close, 99, 98% or so. Of course, we had some Fed speakers that moved the market to a slight degree. This is what we look like in terms of the Federal Reserve, not the Federal Reserve, but the Fed funds futures that predicts the next and subsequent interest rate decisions. November 14th, we had a 0.2% chance that in January, the Federal Reserve would raise interest rates. Basically zero. There was a 64.47, let's say 65% chance the Federal Reserve would cut interest rates in their May meeting. The May meeting is important because this is the first meeting where there's more than a 50% chance that they'll ease rates. So, and on November 14th, we had a 65% chance. As of today, we have a 79.56, an 80% chance the Federal Reserve will cut rates May 1st. That is the May meeting. So we were at 65, we're now at 80. So certainly, and this is not only a result of today's GDP revision, but also recent Fed speakers and some other numbers. Of course, we have moving forward inflation numbers this week that certainly could be a very big deal. The last inflation numbers showed a decline. We're not at the 2% inflation target yet, but certainly going in that direction. So, with that said, how does this affect the stock market? Well, the stock market, generally speaking, likes lower rates. As long as those lower rates don't indicate that there is a decline in the economy, that, good inflation comes down, but not at the expense of jobs, not at the expense of durable goods. Well, not at the expense also of GDP. That doesn't seem to be the result today. So today's number looks great. Uh, and we'll have to see how the Federal Reserve futures move in response to our new inflation numbers that we're expecting pretty shortly. We hope this has been helpful. We look forward to seeing you back soon.